Hello, everyone. Welcome back to our second video on this YouTube channel, StudVest. And today we're going to talk more about the mindset. The reason I think not everyone you should not dive directly into investment is because this is what I did before, and I faced its consequences. Um, Usually, as I said in the last video, a lot of people invest when the market is in an upward trend, right? So let's say a person invests over here and the market reaches to a higher point. So they see profits, okay? And they're like a little bit more, a little bit more, a little bit more. So let's say you invested $10 in something. You will be like, okay, now this $10 you invested right here, okay? It has turned into $50, let's say, right? So you will be like, okay, $50. Let me wait. It'll go $75. Okay. You will wait for 75. Okay. You will wait for 75. And then from 75, you will keep on increasing your expectations. And there'll come a time when the market will just crash down. Right. So this is the whole thing I wanted to tell you. Like without the mindset, without developing the mindset, you cannot invest. You cannot just buy some asset that I tell you that buy XYZ. You buy and that's it. Right. You need to have a mindset. And that mindset comes with either experience or through knowledge or through both, right? So I want to share some mindset tips and tricks with you before we move on to the technical part of investing or how it's done. The very first thing I want to tell you is that there are two ways of doing investment. One is the trading way, and another is the holder way. Okay, it's called HODL. Okay, so there are two ways, again, as I said, trading way and the holder way. I am pretty much sure you guys understand by the terms itself. The holder way is where you buy your assets. Okay, you buy and you hold. Okay, you never sell. Okay, never sell means if the market is, so let's say you bought over here. Okay, you bought over here, right here. Okay, the market is increasing, you're getting profits, you don't sell. Okay, the market comes down, down, down. It goes beyond your buy price till you won't sell, and then it goes up and then down, up, down, up, down, until and unless it goes exponentially high, like this high. You will not sell it. You will hold it. Okay. At this moment, you'll be like, okay, I invested $10 and it's now just like $2. Or what am I doing? I'm getting a loss and this and that. No, trust the process, because I know it's the first time you guys invest, and it's a bit scary because the first time is always scary. So similar thing happened with me, and I always used to buy high and sell low, and usually it's buy low, and sell high, right? Usually because you want to buy low and sell high profits. I used to buy high and I used to sell at a loss. Okay, the typical emotional investing part. The another way of investment is that you trade. Now trading is done somewhat like this: that say you open a position over here. Position basically means that you buy something, okay, and the point where you buy it on the chart, that's a position. The price goes up, okay, it comes down a little bit, it goes up, comes down, and you make a profit here. Okay, you sell it. So in the short term, you've made your $10 into, let's say, $12 or something. Okay, then it goes a little bit up and then it comes down, and then you buy over here again, and then it goes a little bit up, you sell here, and then it goes down, up, down. So you ride the wave basically, right? You buy, you sell, you buy, you sell. Okay, in short terms, $10 turn to 12, your 12 turn to, let's say, 14 and whatnot. This one, what happens is you hold $10 and you wait for it to turn into $10,000 or whatnot, right? Yeah. Now, looking at the charts, you will feel that this is a much better way, and I will agree to you, this is a much better way of investing. This is a much better way of investing. The reason, because you are making profits as you gain them, right? You're riding the wave. So you gain a profit, it goes down. You buy low again, and you sell high. Here, you're not utilizing the market properly, right? Here, you're utilizing the market properly. However, there is a catch. This is an advanced way of buying assets. The reason I say advanced is because you never know when the market is going to go down, right? So you buy here, but you don't know, okay, the market goes up, will it go further up or will it go down? You buy over here. Are you 100% certain that the market is going to go upwards from here, or is it going to go down like this over here, right? You don't know. So you might be in a loss as well. So this is something advanced, and this is something that we are not aiming on this channel. What we are aiming is to buy and hold. We want to purchase assets, and we want to Basically just wait for it to mature and then gain profits from it. The second thing I would like to tell you is about investment amount, right? So the investment amount, it's so let's say you have $100. Okay. Thumb rule, you will not invest $100 into your what do you say into one asset. Okay, let's say we have asset number XYZ. No matter how good the asset is, you will never ever invest $100 into one asset, right? So your budget is, let's say, $100. Okay. So let me tell you how to make budget also at first. Okay. So let's cancel out this. Let's draw it over here. Let's say you have $1,000. Okay. This is your entire savings. Okay. That you use, you're saving it for a lot of other things as well, right? So you have $1,000. Thumb rule is, this is what I do. If you're really, really getting started and you really want to be very safe, I would say take 10% of it. Okay. Take 10% of it. You can take 20% of it. You can take 30% of it. You can take 40% of it. But I will recommend you not to go beyond 50%. Okay. Because with investing, there is a psychological factor also involved in it. Imagine you put in your $1,000 into investment and they turn into $500. You will always be like, oh my God, I should not have invested because you lost a lot of your money, right? So always invest the amount of money you feel you're ready to lose. You feel like, okay, if I lose this amount of money, yeah, it will be painful, but I'll always get over it because I still have, let's say, my $900 left because, I just invested a part of it, right? So let's say we go for 10%. Now you have a total of $100 to invest. Okay. You have a total of $100 to invest in multiple assets. Never ever invest in one asset $100. You should always have a diversified portfolio. So let's say this much percent in this asset, this much percent in this. If you're finding that one asset is really good, fine, get a big chunk of it, but never invest your entire amount of money into that. So this is asset XYZ, the really good one. This is asset ABC, a little bit good, but not good compared to XYZ. So you should build a diversified portfolio and its total value will be $100, right? So this is the second thing I wanted to tell you. The third thing is about tracking your investments. This is the third and last thing I wanted to tell you was tracking investments, right? So tracking investments is very necessary because, today you buy some asset, it's stored in your account or in your wallet, whatever. You might forget after 2-3 months where did you store it, because you're not going to come in every day to check in what's the price and what's not the price, because again, as I said, in the buy and hold strategy, you buy and you just forget that you bought something, right? You just keep it there. Just imagine like you bought Bitcoin in 2013 and you just forgot it existed until 2017 when the hype all came back. You're like, oh yeah, wait, I had Bitcoin. Let me check how much is it value, right? So in that sense, it makes sense to have a tracking sheet of some sort, right? So there are multiple ways you can track. You can make an Excel sheet, okay? Or you can also use online portfolios, okay? Online portfolios. You can also use a paper pen diary, okay? A diary, a paper pen system. It's up to you, right? For the purpose of this investment playlist or series, I will go for online because this is the most easy to use and yeah, so it is the most convenient one to use. So we'll be using the online one. Of course, if you're like you want to store it somewhere physical, you can definitely do that as well because you don't trust the digital systems or the website or whatnot. Another good way going is Excel, but again, we will be using the online one. So the site we will be using is called CoinGecko.com. So CoinGecko.com is a platform where you can get to know the prices of every asset that exists in the cryptocurrency world. Okay, you can see their statistics, their price changes, the volume, the graph. Okay, a lot of other things as well. But what we are interested is in this portfolio feature, right? So when you come here in the portfolio feature, you can see over here that you will get similar portfolios where you're like, okay, I have these many BTCs, I have this much of Ethereum, I have this much of USDT and this much of this asset, right? So you can see a total value, how much it has increased and whatnot, right? It's much more easier. It's much more convenient than Excel, than just writing down that, okay, I bought this at this point and this and that, So it's a bit more easy, right? I will not be showing you how to sign up right now in this video, but at a later stage, in a later video, I will definitely be showing, right? Summarizing what we have learned is the first thing is that we need to hold, okay, and we need to not do emotional buying, okay? We don't want to do emotional buying, and we don't want to do emotional selling, right? We don't want to, let's say we are interested in buying an asset. We don't want to buy in all at once, right? So I'll explain that to you as well. So the second thing is we have our savings, okay? So we need to take, let's say, a decent percentage of that savings. So let's say for now, 10%, you take 10% of your savings. From that 10%, you are going to diversify your portfolio. You're not going to invest in only one asset, no matter how good it is. You're going to diversify your portfolio. And let's say you have an asset XYZ. You had $100 and you're like, okay, this is a very good asset. I'm going to invest $15 into it. Never ever invest all $15 in one go, right? You have to invest. Dollar cost averaging. There is a concept called DCA, which basically means dollar cost averaging, where on a, let's say this is time, okay, and this is your price, right? This is your price, this is your time. So day one, you buy over here. Day two, you buy over here. Day three, you buy over here. Day four, you buy over here. So what happens in this is the average price of what the asset you're buying comes out to be nice. It comes out to be even, balanced. So let's say you have $15 and you figure out that there's an asset called XYZ and the price is this much. Imagine you put in $15 right here and the next day it just goes down, right? So there's no sense. But if you put, let's say, $1, okay, you put $1 over here and then it goes down, you're like, oh, no problem. I'm just going to buy more over here. So I'm going to spend $1 more over here, right? I'm going to spend $2 more over here if the price is significantly lower than what you had purchased before. It starts going up, no problem. I'm going to buy $1 more. Because in the short term, you think that these prices matter, but in the long run, the price will increase so high that if you bought it over here or you bought it at this point, it wouldn't matter, right? Because your price is anyways going to multiply 100 times or 1,000 times, right? The third and last thing is tracking your investments. And that is a very important thing, as I said last time, tracking. So for this purpose, we'll be using CoinGecko, which is called CG in short terms. So yeah, so these are the three things. Hold, don't do emotional buying and emotional selling. From your savings, take a percentage amount, 10%, 20%, 30%, don't go beyond 50% in my recommendation. Diversify and yeah, track your asset.